All right, so looks like you've been digging into investing lately,
Mm-hmm.
and we're here to help unpack some recent market trends with you.
Sounds good.
We're diving deep today into an article from Wealth Insight magazine called Investment Acorns, When Hot Stock Picks Leave Investors with Financial Frostbite.
Ooh, that's an interesting title.
Yeah, what do you think about that title?
Well, it sounds like it's going to be about
Yeah.
the dangers of chasing, those hot stocks that everybody's talking about.
Yeah, those trendy picks.
Yeah, exactly.
Yeah.
And how that can sometimes backfire.
The author is Aashish P. Somaiyaa, who's the CEO of White Oak Capital Asset Management.
Okay.
So he probably has some experience
Yeah, he probably knows what he's talking about.
with how investors behave and react to the market.
For sure.
So let's see what lessons we can glean from this article.
Wow, let's dive in.
Okay, so Somaiyaa actually had this tweet that went viral a while back.
Oh, really?
It said, if your portfolio is down 30% right now, it was never a portfolio. It was a list of stocks that you thought were good picks for some reason, or a list of your favorite stocks.
Wow.
That's a pretty bold statement.
It is, yeah.
What do you think about that?
I think there's some truth to it.
Hmm?
A lot of people maybe misunderstand what a portfolio really is.
So you're saying it's not just like a shopping list of stocks?
Right. It's not just a collection of companies you like or think will do well.
Yeah, like my pantry isn't a meal plan just because it's got food in it, right?
Exactly.
Yeah.
More strategic than that.
So how does someone actually build a real portfolio then?
Well, it starts with understanding benchmarks.
Benchmarks?
Yeah, like, the Nifty 50 index.
Okay.
That's a benchmark for large cap Indian stocks.
Right.
It gives you a sense of how the overall market is performing.
So it's like a reference point?
Exactly.
Yeah.
You compare your portfolio's performance to that benchmark.
To see if you're doing better or worse than the market.
Yeah. And to see if you're taking on too much risk or not enough.
Gotcha. So benchmarks help you evaluate your investments in a broader context.
Right. And then you have to think about risk and return.
Because higher returns usually come with higher risks, right?
Exactly. You want to find that sweet spot, where you're comfortable with the level of risk you're taking.
Makes sense. But how do you actually measure risk?
Well, one way is through standard deviation.
Standard deviation.
It tells you how much your investment's returns are likely to go up and down.
So like how bumpy the ride might be.
Exactly.
Yeah.
A higher standard deviation means more volatility.
Oh, so more of those ups and downs, like a roller coaster.
Precisely. And that can be exciting for some investors,
Mm-hmm.
but terrifying for others.
So if someone's portfolio is down 30%, like Somaiyaa said in his tweet,
Yeah.
could that be a sign that they didn't really understand risk?
It could be. It might mean they were chasing those hot stocks without a clear strategy.
Ah, so they weren't thinking about the bigger picture.
Exactly. And they probably weren't paying enough attention to benchmarks either.
Which brings us back to Somaiya's experience, right?
Mm.
He's seen how investors react when things go wrong.
He has. And, one thing he's observed is that
What is that?
people tend to pull money out of mutual funds to chase those hot stocks.
Really? So they're abandoning a more diversified approach for quick gains,
Yeah, they're essentially betting on individual companies.
which can be super risky.
It can be very risky
Yeah.
because you're putting all your eggs in one basket.
And that basket could have holes.
Exactly.
So this is where the financial frostbite comes in.
Right. When you're chasing what's hot, you're not really investing, you're speculating.
And when that hot stock cools down,
You can get burned.
ouch. So is Somaiyaa saying that mutual funds are the only way to invest?
Not necessarily,
Mm.
but he does believe that they offer a more balanced approach.
Especially when it comes to mitigating risk.
Exactly. Because mutual funds pool money from multiple investors
Mm.
to invest in a diversified portfolio of assets.
So you're spreading the risk,
Right. And potentially reducing the impact of losses from any single stock.
which could be really valuable in this current market.
Absolutely.
Ah.
Especially with so much volatility.
But what about those who are drawn to direct equity investments?
You mean picking individual stocks?
Yeah, there's something exciting about being in the driver's seat.
I get it. It gives you a sense of control.
And with online platforms, it's easier than ever to access the market.
That's true. We've seen a huge surge in demat account openings.
Yeah, and even SIPs haven't kept pace with that growth.
So how do we balance this desire for control with the need for a sound investment strategy?
That's a great question. And it's something we can explore further as we dig deeper into Somaiya's insights.
Sounds good. Let's keep going.
Okay, so let's move on to the next part of the article.
Yeah.
Okay, so we've talked about benchmarks and risk and diversification
Right.
and this whole idea of direct equity investments.
Mm.
But how does this actually play out in the real world?
Well, Somaiyaa, he shares some pretty interesting stories from his own experience,
Yeah.
interacting with investors.
Oh, yeah.
Like he's seen people pull money out of mutual funds
Really?
to chase those hot stocks,
Wow.
only to see them plummet when the hype dies down.
Yeah, it's that classic, buy high, sell low thing.
Exactly. It's the opposite of what you want to do.
It must be tough to, watch that happen.
It is, yeah. Especially when you've tried to warn people
Yeah.
about the risks.
It really shows you how emotions can influence investing decisions.
Definitely. When you get caught up in the excitement, it's easy to forget about the fundamentals.
Right, you just get swept up in the moment.
Exactly. Like at an auction.
Ooh, yeah.
You get caught in a bidding war.
And end up paying way more than you should.
Precisely. That's why it's so important to have a plan.
A strategy.
Yeah, a well-defined strategy to keep you grounded.
So you don't make those impulsive decisions.
Exactly.
Somaiyaa also talks about knowing your own risk tolerance. What does that even mean?
It means knowing how much volatility you can handle.
Volatility?
Yeah, like how much are you comfortable with your investments going up and down?
Oh, okay. Some people are fine with big swings.
Right.
Others prefer a more steady path.
Exactly. And there's no right or wrong answer.
It's about finding what works for you.
Exactly.
So where do mutual funds fit into all of this?
Well, they tend to offer a more diversified approach and potentially less volatility.
But don't they sometimes underperform compared to certain stocks?
That can happen. Yeah.
So it's not like a guaranteed win?
No, not at all. You still have to do your research and choose the right funds.
Well, it's not as simple as just throwing money into any mutual fund.
No, definitely not. There are different types of funds with different strategies.
Oh, I see.
You have to consider things like the fund's historical performance and the fees it charges.
Gotcha. So you still need to be an active participant.
Yes.
Even if you're not picking individual stocks.
Right. It's about making informed decisions.
That line with your goals.
Exactly. And Somaiyaa, he even mentioned something called the information ratio.
Information ratio.
Yeah, it sounds complicated, but it's basically a way to measure a portfolio manager's skill.
Oh, okay.
It tells you how much extra return they're generating for the amount of risk they're taking.
So a higher information ratio is better.
Generally, yes.
Yes.
It means they're making smarter decisions.
So it's like a gauge of their expertise.
Exactly.
Okay, so we're starting to get a clearer picture of how to approach investing in a smart way, but how do we actually put this into practice?
That's a great question. And I think Somaiyaa's insights can help us with that.
Okay.
He has some practical advice on things like diversification and asset allocation.
Okay, so let's get into the details.
What's it?
Okay, so we've covered so much ground.
We have.
From benchmarks and risk tolerance to those hot stocks and even mutual funds. I'm curious to hear more about Somaiyaa's practical advice, on building a resilient portfolio. Right. Where do we even begin?
Well, he starts with diversification.
Okay.
You know the old saying.
Don't put all your eggs in one basket.
Exactly. And that applies not just to individual stocks, but to different types of assets.
So stocks and bonds.
Yeah.
Maybe even real estate or commodities.
Right. The idea is to spread your investments.
To reduce your overall risk.
Precisely. And the specific mix you choose depends on you.
On my risk tolerance, my goals.
Exactly.
He also talks about asset allocation. Is that the same as diversification?
It's similar, but there's a subtle difference.
Yeah, okay.
Diversification is about spreading your investments, while asset allocation is about deciding how much to put in each asset class.
Oh, I see.
What percentage goes to stocks?
Yeah.
What percentage goes to bonds?
So it's fine-tuning the mix.
Exactly.
To match my risk appetite.
Precisely.
So if I'm a conservative investor, I might have more bonds in my portfolio.
Right, because they're generally less volatile than stocks.
Gotcha. And Somaiyaa says this allocation shouldn't be static.
Right. It should be dynamic.
So it changes over time.
Exactly. As your life changes, your investment goals and risk tolerance might change too.
That makes sense.
Yeah.
You wouldn't use the same recipe for every meal.
Exactly.
He also stresses the importance of having a long-term perspective.
Yeah, investing is a marathon.
Not a sprint.
Right.
So even when the market dips, you got to stay focused.
Exactly. Don't get distracted by those short-term fluctuations.
Because over time,
the market tends to recover.
Somaiyaa actually points out that in this downturn,
Yeah.
the average mutual fund has lost less than individual stocks.
Right, like 10% to 20%.
Which is still a loss,
Yeah.
but it shows how diversification can help
It does.
mitigate those losses.
Exactly. And
Yes.
prevent those moments of financial frostbite.
That Somaiyaa talked about. So as we wrap up our deep dive today,
Yeah.
it seems like the key takeaway is that
Yeah.
investing isn't about chasing those hot stocks
Uh,
or trying to time the market.
It's about having a solid strategy.
That aligns with my goals and my risk tolerance.
Exactly.
And that strategy should include...
Diversification, asset allocation,
Okay.
and a long-term perspective.
Got it. Well said. So to everyone listening out there,
Yeah.
remember, knowledge is your most valuable asset.
Absolutely.
Keep learning, keep asking questions, and keep diving deep into the world of finance.
Until next time.
Happy investing.